Alright friends, welcome back to third module. We are going to discuss about various types of life insurance policies and various types of general insurance. If you look at the life insurance policies, people often talk about endowment policy. What is the meaning of endowment policy? Let us take for an example, a person X has taken endowment policy for 20 years. That means a person has taken a life insurance policy for a term of 20 years. And here there are two issues. One is what will happen if the person dies before 20 years, and what will happen if the person lives beyond 20 years. And let us take both the cases. The person died after 8 years. The first case is, let us assume that the person X died after 8 years, and after the death, then the nominee, or you can say loosely called beneficiary, will get these death benefits. Whatever the sum assured, there was an understanding before giving the policy by the insurer to the insured, what is the sum assured, and if it is 5 lakhs, that 5 lakhs will be paid after the death of the person, after the death of the insured. That means if X dies after 8 years, the nominee will get death benefits immediately, right? So this is a death benefit. Basically, the concept of insurance is to act as a risk mitigation mechanism. That's why the family will get death benefits if the person X dies after 8 years. But what will happen if the person lives beyond 20 years? The person lives beyond 20 years, in most of the cases it will happen. If the person lives beyond the term of the insurance policy, then the person will get maturity benefits. So here, if the person dies before the term of LIC policy, then the nominee will get death benefits, and if the person lives beyond the term of the policy, then what will happen? The person will get maturity benefits. And you may ask, what about premium? Premium which is to be paid every year, the premium can be paid monthly, quarterly, half yearly or yearly, and the premium to be paid annually will depend on basically two things. One is age at entry. If the person is taking insurance premium at the age of 20 years, the premium will be much less in comparison to the premium for a 40-year person. That means when the age is less, premium will be less. And second, the premium to be paid also depends on the term of the policy, right? So the premium depends on age at entry and the term of the policy. And in endowment policy, what will happen? Death benefit will be there if the person dies before the policy term, and if the person lives beyond the policy term, he will get maturity benefit. So here either death benefit or maturity benefit. So this is the feature of endowment policy. And endowment policy, whatever the premium we pay, it will have three components. One is expense component. That means the expenditure of insurance companies. Insurance companies are required to bear the administrative costs, or required to bear the agent commissions. All this will be expense component. The second component is the mortality component. The third one is investment component. Why investment component? Because if the person lives beyond 20 years, he will be getting some maturity benefits. That's why this investment component will also be there. So whatever premium we are paying under endowment policy will be divided into expense component, mortality component and investment component. That is divided by them internally. We have nothing to do with it. We will pay only premium, as it involves three components: expense component, mortality component and investment component. The premium will be higher in comparison to term policies. We will come to know what is term policy now, but please don't forget the premium to be paid under endowment policies will be higher than the premium to be paid under term policies. Right. So, the premium is divided into expense component, mortality component and investment component, that is for their internal calculation. We have nothing to do with it, we have to pay only premium. So, bluntly please don't forget, endowment policy means if the person dies within the term of the policy, the nominee will get a death benefit, and if the person lives beyond the term, the person will get maturity benefit, and this 20-year period is known as maturity period, and the benefit which he gets after the period is maturity benefit, right. If you look at the money back policy is one type of endowment policy. This is having additional feature. It is also similar concept wise to endowment policy, but here the third benefit is also there, that is the survivance benefit. Here what the person will get is every 5 years the person will get survivance benefit in this case, and as usual it will have death benefit. If the person dies below the term of the policy, death benefit will be there. After the end of the maturity period, maturity benefit will be there, and the third type of benefit is survivance benefit is there, that is paid at every 4 years or 5 years. That means the insured will get some amount after regular intervals of 4 or 5 years. That's why these money back policies became so famous. So, if someone asks what is the concept behind money back policy, please don't forget it is the one type of endowment policy, with the only difference at frequent intervals the insured will get some money from insurance company. And if you look at the term policy is as usual within the policy term. If a person dies, nominee will get death benefits. X has taken this policy and he died after 8 years, and the family will get this death benefits. And if the person lives beyond the term of the policy, no maturity benefits. So, here the policy, term policy will cover only death benefit, no investment portion. Only death benefits will be there if the person dies before the term of the policy, and no maturity benefits. And we have already discussed, when we were discussing endowment policy, the premium in endowment policy was divided into expense component, mortality component and investment component. But when you look at this term policy, this premium will be divided into only two components. One is expense component, second one is the mortality component. Here there is no savings or investment component. That means here the premium will be less. It will cover only the life risk. It will not pay any maturity benefits. So, here under a term policy, the coverage is only death. And if the person lives beyond the term policy, he will not get any maturity benefits. So, the fundamental difference between endowment policy and term policy is endowment policy will have maturity benefits and term policy will not have any maturity benefits. Of course, both of them will have death benefits, but endowment policy will have maturity benefits and term policy holder will not get any maturity benefit. So, the premium under endowment policy is high, the premium under term policy is less, right. So, this is the basic difference between two types of life insurance policies, endowment policy and term policy, and money back policies are a subset of endowment policies. If you look at the next type of policy, unit linked insurance plan, popularly known as ULIPs, unit linked insurance plan. Here also what will happen, as usual, the person will get a death benefit. Suppose the sum insured is 5 lakh rupees. If the person dies after 8 years, his family will get a death benefit of this 5 lakhs. But what will happen if the person lives beyond the policy period? If the person lives beyond the policy period, then what will happen? The person will get maturity benefit, but his maturity benefits will depends on the returns on investments. That means unit linked insurance plans will invest the money in shares. So, this unit linked insurance plans are amalgamation of insurance as well as investments in shares. So, insurance as well as investment in shares, that is combined together to form unit linked insurance plans. So, unit linked insurance plan is basically the plan combining insurance and investments. The investments will be made in stock market, and here the insured will have option for selecting various funds where to invest my money. That option will be there for the insured, right? So, this is about unit linked insurance plan, and you may have a doubt, since it involves insurance as well as stock markets, who will regulate these ULIPs? ULIPs are regulated by IRDAI, please don't forget. So, this ULIPs, you have death benefit as well as maturity benefit, but the maturity benefit will depend on your returns in the stock market. So, the maturity benefit is not certain. You have to take certain risk of stock market fluctuations. Right friends, so please don't forget, ULIPs are managed or regulated by Insurance Regulatory Development Authority of India. If you look at the next important plan, that is pension plans. Here, to take care of old age, insurance is combined with pension. These are pension plans. As usual, these will have death benefits. If the person dies after 80 years, the beneficiary will get death benefits, and at the same time, beyond the policy period or beyond certain age, the family will get annual pension. So, the combination of pension and insurance is the hallmark of pension plans, and please don't forget, this pension plans, from which year the pension or annual pension or annuity, if someone says annuity, that is paid annually. So, when this annuity will start, that will be decided in advance, and the age from which this pension will be given is known as the vesting age. This term please don't forget, vesting age means the age from which annual pensions are given under these pension plans. So, if someone says pension plans, please don't forget, it combines death benefits, insurance as well as pension. So, this is about pension plans and reinsurance. As we have already discussed, General Insurance Corporation of India Limited was established in the year 1972, and 4 subsidiaries were formed under it by amalgamating 107 general insurance companies. But subsequent to 2000, specifically in the year 2002, an amendment was brought to delink these 4 subsidiaries from GIC, and these 4 subsidiaries are now owned by Government of India. So, GIC became GIC-RE, and GIC-RE has established its subsidiary in South Africa, please don't forget. This General Insurance Corporation Reinsurance has established its subsidiary in South Africa. And what is meant by reinsurance? These insurance companies will spread their risk with the reinsurance companies. That is the meaning of reinsurance. And the arrangement by which insurance companies spread their risk with the reinsurance companies is known as reinsurance, right? So, now GIC is a reinsurance company, and 4 subsidiaries are now owned by Government of India doing their business of general insurance. And if you look at types of general insurance, health insurance, if something happens, then health insurance is very important. And in connection with health insurance, please don't forget the term TPS. TPS means third party administrators. These TPAs are the link between insurance company and insured. So, TPAs will look at the logistical operation of this health insurance. So, if someone says health insurance, please don't forget third party administrators or TPAs. Accident insurance, that is also part of general insurance. And when someone says accident insurance, please don't forget Pradhan Mantri Suraksha Bima Yojana, that is with rupees 12 premium. Accident insurance cover will be given for rupees 2 lakhs, right? And household insurance, if some theft happens, if some fire occurs, to take care of these exigencies, this household insurance will be taken. Then scooters insurance, motorcycle insurance, then car insurance, all types of commercial vehicles insurance. And as I have already told you, under Motor Vehicle Act of 1988, it is mandatory for every owner of vehicle plying on the public roads to take insurance policy, basically to cover the amount which the owner legally liable to pay as damages to the third party, right? If some accident occurs, there may be damage to the third party. To take care of that, insurance needs this, as per Motor Vehicle Act, all the motor vehicles coming onto the road are to be insured for the third party damages. Then shopkeepers policy, if something happens to the shopkeepers, to take care of that, the shopkeepers policy is there. Then the marine cargo policy, if something happens when something is being transported through sea route. Then this fire policy in industries. Fire in industries is quite common. To take care of that, this fire policy will be there. Then burglary policy. So, these are all examples of general insurance. Except life, all are general insurance. Right friends, with this let us conclude here. Please do join for 4th module. Have a nice day. Thank you.